if you look at this particular paper, it is there in the intermediate level. That is paper number or CA 25. So this particular paper, that is management accounting, has got 10 topics. This management accounting has got 10 topics, and you want to distribute or you want to divide those topics as follows. That is the content which you are required to cover in management accounting. So the first topic, we are going to deal with the introduction. We are going to introduce you to what we call management accounting. How is it related with other disciplines or principles? How is it related with other units? How do we apply management accounting in an organization, both service and goods industry? Remember, those companies that are offering service, they also have costs that they incur to make their services available. Those costs, there are some that are directly related to generating the services, and those that are regarded as overheads, they are not directly related. So still, both manufacturing and service industry or companies that are operating in those different industries are incurring or doing what we call costing system to know the method that will minimize their cost and at the same time maximize their profit. So in that particular context, we are going to look at what management accounting is, the importance of studying management accounting, and even the application of management accounting. That is topic number 1. Topic number 2, we are going to look at now. Remember, we've mentioned that management accounting is basically coming up with information that will help the management to make informed decisions. And therefore, for us to come up with these methods or these concepts that are going to make sense, these facts, then we need to know how to classify them. And that's why we now need to do what we call classification of costs. That is topic number 2. We want to know how are we going to classify costs. There are those that are directly related to the goods that you're going to produce. There are those that you're going to incur at our own discretion. That is, we are not going to fail to do business because we've not incurred such costs, but incurring them may just improve the public image of the company or the social acceptance of that particular company in the area of operation. And that's why even if we don't incur them, still the company will be able to manufacture and sell their goods. They are done out of goodwill. There are those costs that we call opportunity costs. If you don't adopt or accept a given project, then the benefits related to that particular project will be forgone, and therefore we call them opportunity cost. They are not directly costs. You don't withdraw money from the bank account of a company to pay for opportunity costs, but forgoing the next best alternative that you could have invested in is what we now call the opportunity cost. You have 3 options. 1, you can invest in the service industry and generate revenue. You can invest whereby you're going to manufacture goods and then still you generate revenue and even get profit after taking away all the expenses. In that particular point, when I decide to do the service one, my net profit or what I'm going to get at the end of it is 4 million. When I decide to go for the goods, do manufacturing, sells them at wholesale or retail, then I'm going to make what we call 5 million. Now, by going to the goods industry, I am foregoing the service industry. So I'm losing 4 million that I could have gotten when I invested in the service industry. When I move to service industry and decide not to invest in the goods, I'm going to lose 5 million. Remember, this 5 million is not directly lost in the name of maybe doing extra transactions or having more cost than benefit, but it is an alternative. It is the opportunity that you've forgone in the name of accepting the other one. All those information, we are going to discuss them in topic number 2. How do we classify this cost? Remember, cost can be classified according to functions. And costs can also be classified according to variability. So under variability, we are going to look at what we call the fixed costs, and then we are going to look at what we call variable costs. Remember, these variable costs are also classified into two or into other subunits. We have those ones that are directly related to the production of goods. So we have variable production costs. In these variable production costs, we are going to look at what we call direct material. Remember, as you continue producing goods, then you need increase in number of raw materials. And that increase in number of raw materials, it means it is dependent in the goods that you're going to produce directly. If I increase the goods by 10, it means I also need to increase the number or the quantity of raw material by 10. That is direct material. Then under direct material, those people who are involved in the conversion of raw material to finished product, directly involved, we now come and call it direct labor. We now come and call it direct labor. Then any other direct expenses or costs that are related to this. So if I now bring these three together, I'm going to call these ones here prime. I'm going to call them prime costs. That is when you're now classifying these costs, the prime cost. Then we bring in another classification or category of variable cost, the variable non-manufacturing costs, or we are going to have what you call variable production overhead. They are not directly related to the goods, but they vary with increase in quantity of goods produced. We are going to look at them. After looking at the variable production costs of the overheads, we are also going to look at what we call variable non-production overheads. I'm being told that for every unit that I sell, that is selling and the distribution cost can be classified into variable or fixed. For every unit that I sell, I'm going to spend 5 shillings to sell that particular good. So that cost is going to be incurred. It is variable in that it is dependent in the number of units that I'm going to sell, but it does not directly depend on the units of output. It is depending on what I've sold, not what I have produced. So it is variable, but not part of the prime cost. When I now come to the fixed component, we also have fixed production overheads. We have fixed production overheads, which we are also going to look at. The fixed production overheads here, they remain constant within the relevant range. And then there's this other portion called semi-variable costs. So the semi-variable cost, if you decide to represent that in a graph, you're going to look at it in this particular manner. It varies. Reaching a given point, it becomes constant. Then it again varies. So that is the behavior of what we call semi-variable. The fixed cost will be constant all through. That is the fixed cost. And then for the variable, it varies with the units of output. As the unit increases, the variable cost curve is also increasing. That is the variable cost that we have there, the fixed production and the fixed non-production overhead. The salaries and wages. Remember here, this direct labor is being paid to those people who are directly involved in the production of goods and services. But then We now move to the operating expense, whereby you are paying somebody who takes care of the administrative office. You are paying somebody who delivers information to the company. This person is not directly involved in the production of goods, but they are paid salary. So we cannot classify whatever they are claiming from the company as direct labor. No, we now classify them under operating expenses. And in management accounting, we are going to classify them under fixed non-production overheads. The fixed non-production overheads. That is where we are going to classify their claims. The depreciation of assets, fixed or rent and rates are going to fall under this. Remember, for management accounting, we want to look at, is what we are doing really viable? Is it that at this particular point where we're going to get the cost of goods, where you are spending a lot of money, or is it at the operation level, these fixed expenses that are making us not to make profit? How can we minimize them? That is all about management accounting. That is topic number 2. Remember, topic number 2 is giving us the classification of this cost. Because once we are done with topic number 2, my topic number 3, 4, 5, 6, 7, 8, 9, and 10 are going to depend fully on what we are discussing in topic number 2. Are going to depend fully on what we are discussing in topic number 2. For example, if we now move to topic number 3, if we now move to topic number 3, which we call cost estimation. Topic number 3, which we call cost estimation. Under cost estimation, remember, this company want to come up with a costing system, a standard system whereby if I want to produce 40 units, I don't need to come and sit down and again start doing the workings of direct material, direct labor. No, I have an automated system whereby I only input the units that I want to produce. And then at the end of it, I'm able to get or to generate the total cost of those particular units. Now, when you're going to do that, we have methods that you're supposed to apply in doing cost estimation. So number 1, we have what we call list or regression method. We are going to look at that, how to come up with the cost function. Remember, all of them must lead you to this cost function, y is equal to a plus b x, whereby our y is the total cost. Then our A is the fixed cost component. Then our B is the variable cost per unit. And this X here is the units produced or units of output. That is what we have. So at the end of it all, you need to arrive at this particular function. Once we have this, we'll be able to get the total cost. We will be able to get the total cost if we are given X, that is the units to be produced. If I want to produce 40 units, I already know my fixed cost and variable cost per unit. My total cost will be fixed cost plus variable cost per unit. I multiply by the units that I'm expected to produce. Then adding everything here will give me what we call the total cost. That is what we cover in topic number 2. So this one here is arrived at using how many methods? These methods that we are mentioning here. We have regression method. In some books, they are going to tell you that it is called ordinary list square method. In some books, they are going to tell us, no, use ordinary least square method to give us the cost function. So if you get the ordinary least square method, somebody somewhere will be saying that, no, we were not taught that. We have not been taught anything of such kind. So it is the same name as the regression method. We are going to use what we call I-law method. We are going to apply the I-law method to also help us arrive at this particular function. We are going to use what we call accounts analysis method. For accounts analysis method, remember, they are going to classify these costs into variable and fixed. Of course, they will not give you directly. They will tell you that we have, for example, we have salaries or we have direct labor expense. Direct labor expense, then what do? They will tell you that it is 40% variable. So if it is 40% variable, it means the remaining 60%, of this expense here will be fixed. So we classify the costs into variable and fixed. Once that is done, then we'll be able to now move forward to get this particular function. Then we have what we call industrial engineering method. So for our class, of course, there are some other methods that are there, but for our class or for this particular unit, we are going to concentrate on these 4. So remember, for us to do all these 4, if you're going to deal with I-law, if you're going to deal with I-law method or regression method, we must identify what we call the cost driver, the independent variable. So in the question, you'll not be given Y and X. No, the examiner will basically tell you we have production cost, and then we have machine hours. Another one will give you these titles. We have sales revenue, and then marketing costs. So sales revenue in shillings, also marketing costs in shillings. Then you are given even for some 3 months down there. You are even given for 2 years. So we have the cost here. Then we have here, let's say 6,000, 7,000, 4,000, something of this kind. The marketing cost, you are given something of that kind. So remember here, they have not told us the cost driver. They have not given us the value of X. It is upon you to know the value of X, or the column that will represent X and the column that is going to represent Y. So that one we are going to discuss to know the cost driver. So this cost driver is the X. It is independent. The production cost is dependent on the machine hours. If I take more machine hours, then it means I'm going to incur more cost on the production. So this production cost is dependent on the machine hours. Once you've identified that, we will basically do away with the production cost and replace this with Y to say that is variable or dependent variable. Then I will come here and say this one here is the independent. It determines what the total cost will be. This one here will determine what the total cost will be calculated. So once you know that, we have to know, we have to identify, we have to change these titles into either X or Y. From there, we'll be able to complete topic number 3. We'll be able to complete topic number 3. So I believe I shared with you the course outline. I shared with you the course outline for those who are in our paid group. I shared with you the course outline. For those who have not joined us, please remember we only have about 3 months for you to do this particular paper. So time is not there. Don't wait for results. If you know very well that you're going to do this particular paper, you can pay a commitment fee, then you start classes. So should it happen that maybe you pass this particular unit as you are waiting for results, your fee will be transferred to the next unit that you want to do. If you are waiting for results and you've not done management accounting, then automatically you just do the adjustment or top up, then we fully register you for this particular unit. As at now, we are giving an offer of 4,200. We are giving an offer of 4,200. But the normal rate is 4,500. So you can take advantage of that to take this offer so that we start learning as early as possible. We have a lot to cover and time is not there with us. So if you're not in the group or in the paid group, you can contact this number here to be assisted. You can contact this number to be assisted on how to do your payment, and then you join us. We have a class today and also tomorrow. We have a session on Thursday and Friday, 6 to 8. Okay, that's topic number. That is topic number 3. Let's see topic number 4. It is called cost accumulation. Under cost accumulation, what are we going to do? We are going to do the allocation of this cost. We are going to do allocation of this cost, but before we allocate the cost, remember, we are going to apply the knowledge in topic number 2, the classification of cost. So for the cost accumulation here, we are going to apply some methods. We mentioned the material cost. We mentioned the labor cost. So we are going to do the costing of direct material. Once you get the direct material, remember it is also going to involve stock. So we have to also look at the stock level. When we are not manufacturing, we are ordering. What will be the economic order quantity, which when we order, we are not going to have excess, we are not going to have deficit in terms of stock level. That one is going to be discussed under direct or accounting for direct material. Still under that, if you're not ordering goods, then it means you are a manufacturing company. When you're going to manufacture, in place of economic order quantity for the manufacturing firm now, we are not going to call it economic order quantity. We call it economic batch quantity. Remember, if I'm going to produce goods in small quantity, then the cost will be high. But when I increase the volume of what I need to produce, the cost will be low. Remember, that one is okay, but it is supposed to be increased up to a given limit, beyond which, if I do that, then I'm going to incur additional cost in storing these goods before I sell them to the market. So to avoid additional cost as a result of overproduction, I need to apply the concept of economic batch quantity. I need to apply the concept of economic batch quantity. If I'm going to buy goods, that company which is buying, not producing, then they need to know the concept of economic order quantity. They need to apply the concept of economic order quantity. So let's look at the same thing, that is cost outline. So that is what we are going to cover here. So for the cost accumulation, what do we know or what do we need to cover here? As you can look at the cost outline, we are able to see that we are going to do what we call accounting for direct material. Accounting for direct material. When I'm going to purchase direct material, what do I need to do? what quantity do I need to have in place in my stock so that I don't run out of stock when any order arrives. Then we are also going to look at essential requirements for material control system. Of course, we are going to look at how to take care of this material. Remember, in the store, we must restrict physical access. We must limit the number of people who are accessing our store. We must have somebody charged with the responsibility of taking care of our goods in the store, such that if there's any deficit, then they are responsible for any deficit without evidence or without supporting documents. Then, still under that, we are going to look at inventory system, the perpetual and periodic inventory, setting of stock levels. I've just mentioned that. Then factors influencing stock levels. If I want to store stock of a given quantity, what factors do I consider? If it is a small farm, then they are not able to meet, they are not able to put that particular stock because they don't have enough cash to do that. Then, if it is maybe the nature of the goods they are dealing with, these goods are highly perishable. So if they keep them here, if they have a large stock at which are also moving at a lower rate, then they are going to lose all the material. They are going to be destroyed. So we also have to look at that as a factor. Then the demand. This good said that if we store this particular stock, then we'll be able to do the replenishment at any given time or within the shortest time possible. Then we are going to do what we call accounting. Of course, economic order quantity I've mentioned. Then valuation of inventory. We now have our stock. We want to do the dispatch of this inventory. We need to apply 3 methods. So in that particular part, we are going to look at what we call first in, first out. Then we are going to look at what we call LIFO, last in, first out. Then we also apply what we call weighted average method. So these ones here, we are going to cover them as we are going to deal with the inventory in topic number 4. Remember, it is the largest topic. It is the largest topic for this particular unit. Once we do that, we are going to look at direct labor. Direct labor, we are going to do the costing or accounting for direct labor. So direct labor here, companies have different ways of paying their employees. Remember, they have those that are employed on permanent basis and those ones who are just hired to offer short-term services. So these companies here have different methods of paying their staff or their employees. You'll find that some people are paid at a fixed rate. There are those who are paid based on units of output. There are those who are paid on hours taken at work. So the units that you've produced is what will determine the amount you're going to be paid or the amount you're going to earn. For some people, then it's the number of hours that they take in a particular job that will help them know what they're supposed to pay. And others, so long as the month has ended, then they are entitled to the fixed rate that was agreed upon when they were being employed. So those decisions, the employment or the payment of these employees, the methods that are applied by the companies will help us also to calculate the wages due to the employees. In the process, those who are going to work on hourly rate, remember, we are also going to discuss something called bonus. If you save the company, they have said it that you're supposed to spend 4 hours, but in the process of doing that work, you've only taken 3 hours. So you've saved the company 1 hour. This 1 hour will earn you what we call bonus. Then the normal working hours in a day is 8 hours. Let's say, for example, it is 8 hours. But then you, after 8 hours have elapsed, the employer told you that, no, we are going to be late. We have to complete this today. And then you are told to extend by 2 hours. So these 2 hours here will earn you what we call overtime. these 2 hours will earn you what we call overtime. Remember the 8 hours here, the 8 hours here is the normal hours for you to work. But when you've worked extra hours after 8 hours, you're going to be paid what we call overtime. So the 8 hours here is what we call the basic pay. When we combine these three, we are going to get what we call wages payable. So this one here can be done at individual level, or there are some kind of jobs that when you do, you cannot do it alone, or you do it as a group. You do it as a group. So that one we are going to call it group bonus schemes. Group bonus schemes. That one we are going to cover still under direct labor. That is still topic number 4. Then, if you look at that, we are going to look at the overheads. Yes, we are going to look at the overheads. We've now dealt with the direct costs. Remember, we said this is basically about what? Cost accumulation. We are going to look at overheads. Overheads. For the overheads here, remember, for a company, when you're going to do manufacturing, it is not that everything revolves around manufacturing or the production departments. No, there are those people in the service department. So these 3 departments here, are what we call, or these 2, these are the service, and then these ones here are the production departments. Now, this is what happens. There are some costs that we are going to incur here, and also both sides. So we have incurred the cost there, but then the units, if you want to look at the units produced, there is no unit that is being produced in Y and Z. But then the service departments are support departments to help us manage to produce these particular units in departments A, B, and C. Now, we want to transfer the costs incurred in the service department to what? To the production department. Remember, there's those costs that are already incurred here directly. We have what we call rent and rates. We have machine hours. Then we have material handling costs. These are overheads. So we've indicated the amounts. We have indicated the amounts. In these other departments also, we have rent and rates being incurred in the service department. We also have these expenses being incurred in the service department. Now, we want to transfer whatever was incurred in the service department to what? To the production department. So whatever is already given to the production department, these ones here, these costs that have already been allocated directly to the production department, we call these ones here primary allocation. Primary allocation. And then we are now going to take whatever is in the service department to distribute them back to the production department. And that is now what we call, when we transfer these ones here to the production departments, then we call it secondary. We call it secondary allocation. So once that is done, we'll be able to know the total cost incurred and get cost per unit. We have the units produced. So we divide the total cost, divide by the units for us to get the cost per unit in each department. That is what we need to know. Now, in the process of transferring this cost in the service department to the production department, which criteria are we going to use? Which method are we going to apply? So in doing that, in covering that concept, we need to learn about two methods. Method number one, we are going to call it continuous stroke repeated method. Then there is the second one, that is algebraic stroke simultaneous method. So in exams, maybe in class you are going to use continuous method. In exam, you find repeated method is what they are giving you. So it is the same thing. In class, you will find that we are covering algebraic method. In exams, they tell you use simultaneous method to redistribute the cost. So these two methods here are what we are going to apply in doing the allocation or the secondary allocation of overheads. The secondary allocation of overheads. That is all about topic number 4. That is all about topic number 4. If we get to, of course, there's that part of absorption of overheads. We budgeted that you're going to spend this part, we've absorbed a particular quantity. So is it over or under absorption? The last part of topic number 4. Topic number 5, activity-based costing. The activity-based costing is basically, remember these topics are related. As you move from one to another, you will see how we are progressively advancing as we move forward. The activity-based costing, remember, is still going to deal with the overheads. But how is it dealing with the overheads? It is dealing with the overheads in that I have rent and rates. So the rent and rates here, I'm going to look at what we call allocation basis. Allocation basis. So I have A, B, C. For rent and rates, the best allocation basis will be area. Area in square meters. So Department A, I've got 40 square meters, 90, 36. When I now come here to rent and rates, the examiner is doing this to me. I'm being given that the total rents and rates for these 3 departments is going to be 4 million. The total machine hours here, machine related costs, we are going to have 36, or let's say we have 3 million. Now, when you get or you want to distribute these 3 million to the 3 departments, I will just come here. So we have machine hours. So I have 100, 150, 300. So I come here and ask myself, the machine hours, I have 100 plus 150 plus 300 will give me what we call 550. So you now come and ask yourself, if 550 is equal to the total, which is 3 million, what will I have for 100 hours? Remember, this one is the total hours. So 100 hours will be 100 hours. I multiply by 3 million, divide by 550. Whatever I'm going to get there is the portion of machine hours or machine related cost that I'm going to distribute to Department A. I do the same to Department B and C, so that at the end of the day, I am going to get the total overheads for each department in relation to the activity being carried out or being compared with that. The canteen expenses. So canteen expense will depend on the number of employees. So it means down here, this company will have what we call canteen expenses, 36 or 360,000. This 36 or 360,000 will be distributed based on the number of employees working in each department. That is activity-based costing. So in activity-based costing, that is topic number 5, we are going to look at what we call also conventional stroke traditional costing system. Here, we are going to say We are not going to look at how these things are related. No, such that the canteen expenses, we look for number of employees. The machine-related cost, we look for machine hours. Material handling cost, be told to just pick one. We are going to be told that the overheads, the total overheads here, the total overheads value, that is 4 plus 360 plus 3 million, we get the total overheads. Even if it is 10 million, that is the total overheads. Then we are just going to be told to pick one. The examiner will tell you whether to take the machine hours or the area or number of employees. You'll be told to pick one. So if you are told to pick one to distribute all the overheads at once, the total here is 550. So you simply come and say, if 550 is equal to 10 million, 100 will be what? So 100 times 10 million divided by 550. If you do that, remember, you are not going to distribute the overheads one by one. No, we are going to take the total overhead value from machine-related cost, rent and rates, canteen expenses, zote pamoja, then we get the cost share for each department. Once that is done, we basically divide by the units if that is what they need. So it is direct. We don't look at the relationship between the costs or the overheads and the allocation basis. That is under traditional method. So we are going to do that in topic number 5. Topic number 6, that is cost, product costing methods. Product costing methods. Remember, there are some goods that passes through several processes, even 3 or 4. So in this particular topic, we are going to look at the cost we are going to incur from process 1 to process 2. We are going to look at the losses. There are losses that are allowed, the normal loss that must occur if you're going to deal with a liquid. The evaporation or spillage is allowed up to a given quantity or of a given percentage. Anything beyond that, we are going to call it abnormal loss. Anything below that, we are going to call it abnormal gain, because there is observation, there is conservation of the activities being done, and therefore they have been able to save on or below the required loss. So we are going to get what we call abnormal gain. We are going to deal with abnormal loss. We are going to look at normal loss. That is the process. Once that is done, at the introduction part of it, we are going to look or move further and check what if we are given work in progress. So we are going to deal with what we call opening work in progress. We are also going to deal with closing work in progress. In this particular topic, the direct labor and any other direct expense and overheads are now going to be called a new name called conversion cost. So in exams, you may find them giving you this on separate basis, or they just tell you direct material. So direct material will remain either way. And then down here, they summarize everything and tell you conversion costs. They give you the value. So that one is what we need to put in place. Once that is done, remember the opening work in progress, the closing work in progress will give us what we call now the percentage. Imagine you are being told that material, direct material, that is now closing work in progress. You are being told that direct material is 100% complete, but direct labor is 40% complete. Then overhead is 60% complete, or even let's talk of 20% complete. Are you able to give us the cost? If you are given the cost and you are given these percentages, Are you able to give us the cost of producing such particular goods in that particular period or in that process? That is what we are going to look at. And once we are given this, the percentages of completion, again, we are going to look at this method. Are we going to use FIFO, first in, first out method, or are we going to apply weighted average method? It again comes in this particular topic. That is the first part of it. Another part of it, there are some goods that when you produce, you only have one raw material, but at the end of it, you are getting more than one final output, not byproducts. You are getting more than one final output. For example, we have petroleum. When petroleum is processed, you are going to get what we call kerosene. We are going to get diesel. We are going to get grease. So these ones here are the final output, not byproducts. So it means we are calling them joint products. I bring in my material, that is petroleum, 10 liters. Process it, and at the end of the day, I'm going to have 2 liters, I'm going to have 3 liters, I'm going to have 4 kg. Then, how will I apportion the cost that I incurred to produce these goods to this particular output? That one also is covered in this particular topic. There are those goods that the joint products, after reaching this joint point, we can do further processing to increase to add value, to do what we call value addition. When we do further processing, we are going to incur additional cost. So how do we apportion those costs? We are going to look at 3 methods here: net realizable value, then sales value method, and then volume of or units of output. Units stroke volume of output method. So that one also is what you're going to cover to do the apportioning of the cost incurred to produce the joint product. Once that is done, we will be through with topic number 6. When you come to topic number 7, when we come to topic number 7, that is marginal and absorption costing. So the only difference between those two, as if you can look at the course outline, we only need to know the difference between marginal costing and absorption costing. Then we look at the comparative income statements, arguments for, arguments against, and then we reconcile. Remember, we are using same items to do costing or to come up with the comparative statements for both marginal and absorption costing method. The only difference between these two is very, very simple. The only difference between these two methods is how we are going to treat the fixed production overheads. That is all. If we know how to treat this under the two methods, you are done with that particular topic. Because one method argues that the fixed production overhead cannot be part of the cost of the product, while the other one says that the fixed production overheads is part of the cost of the product. And in applying that, one charges this as an operating expense, while the other one puts it as an asset. That is, remember, if I have fixed production overhead as part of the cost, and I have some materials that I did not sell, or units that I did not sell, then I will be able to do what? I'll be able to take this to the current asset section as inventory or closing inventory. So that difference is what makes the profits down here not to be equal. So for us to know if the profits are not equal, then we come up with what we call reconciliation statement. We are reconciling the statement or the net profit as per marginal and absorption costing for us to arrive at the the balancing figure. So that one is covered in topic number 7. So absorption costing, absorption costing, stroke full costing method. So I want us to take note of these other names that I'm giving you, because in exams, the examiner may not be using the one you are used to. They bring in the other one. So you will find that I'm very keen on giving you the other names. Then we have marginal costing, which we call variable costing system. So the marginal costing, it only recognizes direct material, direct labor, and any other variable overhead or variable production overhead to be cost of the product. That is under marginal costing. For absorption or full costing, it recognizes direct material, direct labor, variable production overhead, and fixed production overhead to form part of the cost of that particular product. So this one here forms the cost, but here it is only this three. So you can see how the method treats the fixed production overhead is what makes them to be different. And that is what we are going to look at in that topic. The next topic is topic number 8. Our next topic is topic number 8. Our next topic is topic number 8. That is cost volume profits analysis or break-even point analysis. Here, we are going to look at how many units do we need to produce for us not to make loss, for us not to make profit. How much do we have in terms of revenue? That is, the break-even point will be in terms of units, will be in terms of revenue. That is number 1. So we're going to consider it again into 2 categories, for one product and for multiple products. We are also going to look at what we call margin of safety in this particular topic. In the same topic, we are going to look at what we call target profit. So this target profit, we can have it before tax, and also we can have it after tax. Remember, in this topic, we only know 2 things. In break-even point analysis, we only know 2 types of costs. It takes us back to which topic? Number 2. So number 2 is the backbone of everything here, from topic number 1 to topic number 10. Topic 2 will become the point of reference all through. In topic number 7, we only know, or topic number 8, we only know 2 costs. We either have fixed cost or variable cost, irrespective of whether it is part of the cost of the product, it is non-production variable. But what we need to know is that we only know 2 types of cost. That is the fixed and variable. So once we've known the fixed and we also know the variable per unit, our break-even point in units will be total fixed cost over contribution margin, which we normally say it is selling price per unit minus variable cost per unit. Some examiners also will decide to confuse you and tell you that average revenue is equal to 40. This term average revenue, just call it sales or selling price per unit. Selling price per unit. So instead of struggling to get to understand what average revenue is, it is the selling price per unit. So examiner may just decide to say, okay, this concept is very simple. To make these people confused, tell them that selling price is not selling price. It is average revenue. Then all of them will not know what to do. So that is what we also need to understand in that particular area. So this one here, the break-even point, this one here is in units. In shillings, we are going to take total fixed cost over contribution margin ratio. The contribution margin already we have said it is selling price minus variable cost. Contribution margin ratio will now be contribution margin over total revenue. That is what we need to have there. If you've known that, you look at the assumptions of break-even point analysis, the break-even point, that chart. Are you able to draw the chart? Are you able to draw the chart? This one is the total revenue. If I sell 0, I'm going to get 0. The total cost starts at this point. At this point, I've produced 0 units, but I'm already incurring some cost. Why? Because of the effect of fixed costs. Because of the effect of the fixed cost. At this point, I'm getting break-even point in units. I'm getting break-even point in shillings. And then anything below it will be loss. Anything above this point will be profit. This portion here is what we call the variable cost. That is topic number 8. Once you've known that, then I think we are through with topic number 8. Of course, there's something that is remaining, the application of this concept, the break-even point analysis. I have product A, T, L, M. All of them need to be produced, but I normally use material X. Material X is limited in supply. So I want to check which one should I produce. I do not know how to distribute this raw material to produce these goods. So how do I do it? That is now the limiting factor method. That is the application of break-even point analysis. Should I make or buy? Should I accept the order or reject the order? All those questions will be answered in topic number 8. Topic number 9, we've done everything. As a company, we've done everything. We've even set the break-even point. We are now moving to what we call budget. Are we now able to set budget now that we have the knowledge? Now that we have the knowledge of all costs in a manufacturing or a service company, are we now able to come up with what we call budget control or budgetary control? Am I able to come up with a budget? Or remember the budget here, if I'm going to have functional or master budget, I must know the demand of my product in the market. From there, I will know what to produce. By knowing what to produce, I will be able to know the quantity of raw materials I need to purchase. I will also be able to know the amount I'm going to incur to pay as direct labor costs. From that particular point, I am able to come up with a budget. That is done. Then, still moving down, I want to do some purchases. I want to do some sales. Of course, maybe I'm not going to do 100% cash sales. I'm going to have maybe 70% of my customers purchasing on credit. If I make these sales on credit basis, how am I going to collect them? Am I able to have the probabilities of these people paying me within the required time? Can I classify my creditors into some percentages that the 10% of my sales will be cash? Then the remaining 90% of my sales, 70% of them will pay within 1 month. 20% of them will pay within 2 months. 5% will pay within 3 months. Then 5% will be bad debts written off. So I've known the amount of cash that I'm actually going to receive. Remember, we've also seen some cases whereby a company is making sales of 10 million in a month, but they don't have an amount or cash to pay their employees at the end of the month. So some people are saying that they associate sales with cash. You can make 10 million, 9.9 million is on credit. Out of 9.9, 9 million becomes bad debts written off. The remaining 0.9 million is being used to pay for rent and rates or purchase raw material. You don't have money to pay salaries. You don't have money to do repairs. You don't have money to do maintenance. Why? Because you've not done a clear strategy here. You sell 10 million, 9 million is on credit. 9.9 is on credit. Out of 9.9, 9 million is bad debts. They have refused to pay you. The amount that is paid, 0.9, is again being used to meet the immediate expenses that you cannot avoid. So we cannot associate sales with cash. So as we are going to do this as a company, we need to plan. Having set these percentages, what do we want to purchase? Are we having enough money to do that? Our budget will help us to know that. That is budget. Then we are going to move to topic number 10. We've now made our budget. So in the budget, we are going to have budget, and then once you set the budget, you now get to work. You do your work, you complete the entire process. Then we now have two things. We have budget, and then we have actual expenditure on budgeted activities and actual activities. If, for example, material, I budgeted that I'm going to spend 10 million to buy materials. At the end of it, I get that actually I was able to spend only 9 million. It is now introducing us to topic number 10. That is standard costing and variances. I have budgeted, I have actual variance. Is it favorable or unfavorable? If I'm going to spend 10 million under my budget, but I squeezed and got what I wanted at 9 million, I saved 1 million. This 1 million saved, we now call it favorable. We now call it favorable. So we are going to look at that in topic number 10. And remember, this material cost variance is going to entail two things. The material cost variance can be as a result of material price variance, then material usage variance. Maybe this amount saved has arisen from conserving the materials being used or getting the raw material at a cheaper price as was against what was planned. So that is what will give rise to the material cost variance. Then labor cost variance. The labor cost variance is divided into two: labor rate variance and then labor efficiency variance. We are also going to look at those two. What if I have multiple products? The material mix ratio. Am I able to again calculate the variances using the material mix ratio? So once we do all that, we'll have enough time to do our revision and wait for the August sitting for this particular paper. So that is all which is required of you in this particular paper. So as you've seen, it engages a lot. It requires you to be, or try as much as possible to keep on doing revision on the concepts covered in class, and even at times read ahead of the teacher. So to facilitate that, to facilitate your revision in the topics that have been covered, you need revision kit that will be offered to you by RCM at 1,000. If you want to read ahead of the teacher, the concepts are interesting and you don't want to maybe move at our pace, then you have a second option: study text that has got all the topics, all the notes, which will be able to follow. At what price? At 1,500. So if you equip yourself with these two things, and then you also attend our classes, I can assure you that you are not going to do this paper for the second time. It will be a one attempt paper. So I believe that's enough. Those who have not joined, please do by contacting this number. Please do by contacting that number. Currently, we have an offer of 4,200. So this is the pay bill. Account number is your name. And then you forward that message to 07 19 525,000. So I believe that is enough. We've introduced this course and we've just started. So we are going to move forward as you've seen. Unless there's a question with regards to what we've discussed, maybe on how to reach these people for you to get the materials that I've mentioned here. Any question? Any question with regards to what we were covering here? Any question? Any question? Okay, so if there's no question, I would like us to stop at this particular point. So tomorrow we have a meeting at the same time, that is 6 p.m. to 8. So thanks for your time. Have a blessed night and let's meet tomorrow.